the fundamentals for gold stocks are really strong, and I mean they've been improving for almost a year, maybe a little bit longer, because the companies that have huge open pit mines that require lots of energy, their energy costs, which can be 25 or 30% of their overall costs, I mean, those have absolutely plunged.
Nearly 10 million ounces of gold resources through acquisition. This 50-cent stock has received a $2.65 price target from Cantor Fitzgerald. It's the one must-own precious metal stock according to New York Times bestselling author and fund manager Marin Katusa. Learn more at crushthestreet.com/goldstock.
Hello, everyone, and welcome into crushthestreet.com. I'm joined with a returning guest today. He's an expert on precious metals. His name is Jordan Roy-Byrne, and he's with thedailygold.com. He's a chartered market technician, and he's also the author of the 2015 book, The Coming Renewal of Gold's Secular Bull Market, which is available for free. Jordan, thanks so much for joining me today.
Thanks so much for having me. It's a real pleasure.
Jordan, we've seen a pretty substantial uptick in gold here in 2016. And in fact, gold saw its best month since January 2012. Gold rose 10% in just February 2016 alone. Jordan, let's talk today a little bit about what we're seeing here in gold regarding the fundamentals and technicals. Why are we seeing this uptick here in 2016?
Well, I think to start with the fundamentals first, what you're seeing is, gold really started to take off when I think Yellen, about a month ago or so, mentioned the possibility of negative interest rates. Now, Japan, around that time, Japan also went to negative interest rates. And we've talked before about how the real fundamental driving force for gold, I mean, throughout history has been negative real rates. So in other words, you have real interest rates that are declining or declining into negative territory. And we talked about during the bear market, whether you use like the 2-year Treasury or the 5-year Treasury or the Fed funds rate, back when the market peaked 4 or 5 years ago, real interest rates were, let's just say, -3, -4%. It depends on what you're looking at. And those metrics came back to around zero. And so gold, therefore, was less desirable to hold. But what we've seen in the last few months is statistically inflation has actually been picking up. And at the same time, we've seen interest rates plunging. Now, of course, the Fed decided to, if I recall right, I think it was December, they decided to raise rates. Mm-hmm. But since then, bond yields have really been plunging. So that's really bullish for gold fundamentally, because you have interest rates that are going down and you have inflation going up. So real interest rates have been declining sharply in the last quarter or so. And so that's really the fundamental cause for what's been happening. On the technical side, yeah, it's a really amazing move that we've had, especially in the miners. They had a failed breakdown, I believe, on January 19th, where it looked like they were going to break down and have this final breakdown. And then after they broke down for a day, they suddenly reversed course and they've shot up. And if you look at how strong the rebound has been over the last month or so, or month and a half, it's been in line with that rebound we had off the 2008 low. So where we are now, I mean, it's interesting that we're speaking today because precious metals, they've kind of been consolidating for the last couple weeks, although gold stocks have kind of grinded higher while gold's been trading in a like a little pennant consolidation. And today we've seen a huge negative reversal in the gold miners, and gold again has failed to break above 1240, it looks like. So there's rising risk here right now that this big rebound that we've seen is about to correct itself. And two last things I'd mention: if you look at the currency markets, the dollar is getting a lot stronger because the yen, which the yen dollar, so the yen against the dollar, that has been rising, and there's been a strong correlation there between the yen dollar and gold. And the yen dollar had been rising until the last week or so, and there's a potential double top in that market, and it was up yesterday, but today it's at a bearish reversal, strong reversal to the downside, right along with the gold miners. So now that the yen is getting weaker, that's going to give the dollar potential to finally break out. It's been consolidating for about a year. The dollar's in a real bullish consolidation. I mean, people are talking about a double top. That's nonsense. There's no double top. The speculative net positioning in the dollar, about a year ago when it peaked, it was about 100,000 contracts. As of last Tuesday, it was down to 32,000 or 33,000 contracts. And the dollar index, if you look at it, it's only 2 or 3 points away from a major breakout. So the dollar is in position for a big breakout here. And last comment on silver. Silver looks really bad. I mean, silver, if you look at history, another newsletter writer by the name of Steve Seville, he had a post on his blog showing how silver can sometimes really lag gold for 1 or 2 years after gold bottoms. I mean, we saw that not in 2008, but during the 2001 bottom, where silver actually bottomed at the end of 2001. It actually bottomed a year after the gold stocks did, and something like 7 or 8 months after gold did. So I think silver's real weakness here, that's definitely cause for concern in the short term, but it doesn't mean that we haven't seen a bottom for the sector. I just think the bottom that we're seeing with the sector, with the gold stocks and probably gold, this is something that could take a while, where we see silver perhaps make a new low, but the gold side doesn't. So I think this bottom could drag out a little bit like we saw in 2001. I know that was a long answer, but
no worries. No, I wanted to ask you, you mentioned risk in gold and precious metals in general, but I wanted to ask you, what is your thoughts on that risk? I mean, what would you need to see here that would continue to confirm a bull market for gold specifically? Like, what price action would need to be met for you to start being more confident in a bull market trend?
Well, that's a great question. I'd like to see, I mean, we did see a monthly close in gold yesterday, well above 1180 to 1200. And that's just a very key level. You see 1180 to 1200. And so gold, if gold can hold above that level over the next month or so, that would be a very good sign. I mean, I in my service, I cover the miners intensely because that's what we trade, mostly from the long side. And I feel very good about a major bottom being in for the miners. It's a little too soon to say that gold has bottomed. I think there's a chance where gold could retest its low, and maybe it doesn't make a new low. It's just really tricky to see. I mean, if gold somehow can break out of this little pennant and get to 1,300, I think that would be a really good sign that we've definitely seen a bottom for gold. But that's the first thing I'm looking at, is that it's supported 1180 to 1,200. I really want to see gold hold above that over the next month.
So what is ultimately gold's move in your opinion? Do you believe it to kind of move slowly and kind of trade slowly, or do you eventually see gold breaking out substantially, dragging the miners with it?
Well, I think the one thing on that point, the miners coming out of major lows, they really lead gold.
Right.
So we're seeing a lot more strength in the miners, and that's a very good sign. But as far as how gold's going to move, my answer would be fast. I don't think it's going to be a slow and steady move. I think in the scenario that we get this big dollar breakout and gold comes back, I don't think it's going to be a big deal. If gold comes back to 1050 or 1100, wherever the next low is in gold, even if it has a sizable retracement here, I think whenever that next low is, gold, when it comes off that, is going to have a really strong rebound. So even, let's just say gold's going to come down to 1050 or even 1,000 in the next 3 or 4 months because we get this massive breakout in the dollar. Even in that scenario, after gold bottoms, I think when it bottoms, you'd see a really strong run right back up to 1,200, 1,300 and higher into the end of this year. So I hope that answers your question.
Jordan, so you follow the miners a lot, and I wanted to ask you about a dollar price that the miners would like to have that would give them substantial profitability. And for what that would do, I mean, when is the institutional money going to come into the sector? What would it take? And I'm wondering if there's a gold price that, you know, would need to be reached for the miners to have substantial profitability and for the big institutional money to flood into the sector that would give the sector that, like, you know, bulk push, that bulk bull market trend push that it would need. Or does the sector even need the big money to come into it? Will it happen on its own?
Well, those are some great questions there. I think that, first of all, looking at the technicals with gold, I mean, there's a lot of resistance at 1285, and then there's some resistance in the low 1300s, like 1330, if I recall correctly, on the monthly chart. So if we can see gold get above that 1285 to 1330 level, I don't think that's going to happen anytime soon, probably later this year. But if we see gold get above that level, I think that would be a really, really good sign. As far as what price the miners need, it's interesting because the fundamentals for gold stocks are really strong. And I mean, they've been improving for almost a year, maybe a little bit longer, because the companies that have huge open pit mines that require lots of energy, their energy costs, which can be 25 or 30% of their overall costs, I mean, those have absolutely plunged in the last couple of years. Right. And then in addition to that, if you're running a mine in Canada or Australia, most of your costs are in those local currencies, which have completely plummeted. So the cost for mining, especially if you have a big open pit project and you're in Canada, Australia, or any other country where the local currency is very weak, your costs have come down substantially. So you don't even need like 1,1600 to have really strong cash flow and profits. I would go back to what I said technically, getting above the 1285 to 1330 resistance zone. I think that'll be a big key. Now, the last thing, as far as institutional money, I think we've seen institutional money, a little bit of it already come in. I think you've seen that in like the mega cap stocks like Barrick Gold and Newmont Mining. Those companies, because they started to bottom, I believe, last summer. I don't have the charts in front of me, but those major companies, you know, they bottomed first and they've led this turnaround in the mining sector. So I think there was some institutional accumulation there late last year, and then also there's a lot of short covering, I think, in the last 6 weeks. As far as last point here, what will get institutional money to really start coming in consistently? I think, just to touch on the stock market is rallying here, and not to toot my own horn, but a month or so ago, you know, we were talking about how it looks like the market's bottom. You know, it's probably going to rally up to 1950 or 2000 on the S&P, and the market kind of made a weak double bottom, but it's having a huge day today. It's up to 1976. But looking at my chart here, I see major resistance just above 2000 at 2025, 2028, but also 1990 on the S&P. That's another target I have. So after today, I think the stock market can go a little bit higher. But my point with the stock market is when we see the stock market start to roll over again and really threaten to break to new lows, which, I mean, we're some months away from that. Probably you're not going to see that until late spring. That could be, when we see the stock market faltering again, that could be a catalyst for more big money coming into gold and gold stocks.
Yeah, I was going to ask you about your thoughts regarding the stock market. So do you see gold or, you know, gold stocks having an inverse relationship here in 2016?
I think yes, I do, over long periods of time. So not necessarily like over a day or a week, but I think if you're looking at a couple months, there is a strong inverse relationship, especially between gold and the stock market, because miners are a little different. You know, sometimes they can get pulled down or pulled up, like we've kind of seen over the last couple weeks, where, you know, we've been in this consolidation, but miners have been grinding higher and gold hasn't been making a new high yet. So I think in that respect, the stock market rebound is kind of helping the miners. And also, if you go back to January, where remember the market was going down, but gold didn't make a new low, and then the miners suddenly, they made that false new low. That was because the miners were being influenced to some degree by the stock market. So to repeat myself, the inverse correlation is, I think, fairly strong between gold and the stock market. Now, gold stocks, for the most part, they're going to follow gold mostly, but I do think they're a little bit influenced by the stock market.
Jordan, so silver, and we've touched on this slightly, silver has appeared to have lost some steam, sitting under $15, and we're doing this interview on March 1st, 2016. I'd like to recap on your thoughts regarding silver. What are your thoughts? I mean, is it just a technical thing that we're seeing with silver at the moment, or is it a slowdown in the economy that's causing silver to kind of falter here, or are people going to be kicking themselves not buying at these sub $15 levels?
Well, I think people will be kicking themselves, but probably 2, 3, 4, 5 years from now. As I said in my first really long answer, silver, when at the start of new bull markets, or we can say coming off major lows, silver has a tendency to really lag gold. So it's interesting because over the long term, I'm not really concerned about silver and its underperformance here, but I think over the short term, over the near term, silver's underperformance is a cause for concern, because we saw gold made a new high, made a new 52-week high. I mean, the miners, of course, they made a new high. I mean, they've clearly broken their downtrend. Whereas if you look at silver, it didn't go above its October 2015 high. It kind of nearly tested it. I mean, the high was a little bit above 16, and I think this move kind of peaked out at 16 or maybe a couple cents below. On the fundamental side, I mean, right now, look, if you look at gold has a stronger negative correlation to the stock market. And so that's helped gold. And also, gold is more, gold is really 100% driven by negative real rates, whereas silver, I would say 50% of its move is driven by that, and then the other 50% is probably driven by industrial/commodity demand. So, typically gold will bottom first, and then when there starts to be a concern about, well, looks like inflation's going to pick up, then you see silver bottom and start to move and outperform gold. So I'm not, I don't think one has to run into silver right now. I mean, something I'd mention, if you look at the net speculative position in silver, I mentioned how it's really low in the US dollar. It actually hit an 18-month low in the US dollar. And I measure these as, with gold and silver, I measure these as a percentage of open interest, because, there's hundreds of thousands of contracts. So I like measuring it as a percentage. If you look at the percentage, the net speculative percentage, as I call it, in silver, it is the highest that it's been since sometime in 2010 by a very tiny amount. So when I was looking at it, I said, well, that's at a 3-year high. That's very bearish. But then when I looked at my data more closely, I said, that's actually at a 5-year high. So silver, very negative setup here for it to potentially go lower, especially if it can't get above 16. So over the near term, I'm concerned with silver. It looks to me like it's threatening to make a new low, but we'll see. I mean, it's possible it could retest 14 and maybe just kind of base and consolidate there for many, many months. So I love silver over the long term, but it's not time to get into it yet if we're trying to time it perfectly.
So, Jordan, last time we discussed, and again, we somewhat touched on it today, but we discussed gold reacting positively to real negative interest rates. And, with the Fed hinting at a pause in interest rate upward movements and possibly negative yields, not just real yields, but like, nominal yields. What is your thoughts? Give us, your thoughts on what this will do to inflation and its impact on gold going forward in 2016. I mean, do you actually think the Fed is going to do that, or are they going to continue to raise rates, and are we going to continue to have negative yields?
I'm not really sure. One thing is, if you look at recent data, as I talked about at the beginning, inflation's actually picking up, and typically inflation picks up at the end of an expansion, at the end of an economic expansion. Inflation statistically when you go into a recession. So a lot of people, they're looking at the data, they're saying, oh, inflation's picking up, this is great, this means the economy's strengthening. Whereas historically, if you look at that, typically inflation goes up when you're about to go into a recession or at the beginning. So that's something to keep in mind. And it would be interesting, because if the inflation data continues to get strong, the Fed, they might hike rates one more time, and then they'd have to do an about face later. But to kind of bring that back to the action in precious metals, where I'm cautious right here. I mean, it looks to me, like I said, the dollar is ripe for a big breakout. Precious metals could be topping right here, about to correct over the next couple months. The possible reason for that could be talk that the Fed is actually going to hike rates. Now, the thing is, the Fed, they only like to hike rates when inflation is going up. And that's been bullish for gold, other than in the early 80s, because that's the only time that they hiked rates aggressively to bring down inflation. I mean, every other time they've pretty much hiked rates, they always, especially recently in the last 20 years, they always let inflation run faster than it should. So in other words, if inflation's going up, and it's going up strongly, the Fed, that's their cover to be able to hike rates. But and like, let's say inflation's going to pick up this year and it's going to keep going up, the Fed is going to hike rates, but they're going to do it in baby steps, as to let inflation run and to ensure that real rates will remain negative. So in other words, I mean, if inflation is going to go up to 2, 3, 4%, the Fed is not going to hike rates to 3 or 4%. They'll hike rates to 1%, maybe 1.5% if inflation is 4% or higher. So that's their policy. And I think if they hike rates one more time, that could kind of be the explanation for why precious metals correct, why the dollar is breaking out. Another thing to keep an eye on is China, and if they devalue the yuan, or if they let their currency float, that's something that a lot of people are talking about. And if that happens, that could have global deflationary repercussions. I mean, that could also, trigger a big move higher in the dollar, and things like that.
Jordan, so in December, when the Fed did raise the interest rate by the 25 basis points, do you believe that interest rate move was the catalyst for the volatility that we saw in the markets in January? And I guess the reason why I ask is, I don't think the Fed wants, the markets going crazy here in 2016, especially as they go into the presidential election. And I mean, Janet Yellen is a Democrat, open Democrat, and if the markets are kind of going crazy on Obama's watch here, it'll kind of give some firepower to the Republicans, who would just be the alternative for everyone who's mad at Democrats here. So anyways, I'm just curious, what are your thoughts on, how closely the Fed's actions were impacting the stock market here? Yeah,
I mean, that's a good point about their policy and election year. I don't think the Fed, I mean, just hiking rates by 25 basis points, I don't think that's caused the fledgling bear market that we're in right now in equities. I mean, I think, the global growth is slowing. There's problems in China. I mean, the credit markets, they've been rebounding well in the last week or so, but the credit markets were saying there are problems. I mean, remember in 2007, the credit markets were acting up months before the market topped. So there were all these, and if you look at, the S&P had held up well in 2015, but the Russell 2000, emerging markets, there were all these other indices that were getting killed while the S&P was, 5-6% or 2% off. So I think the Fed hike it's like a simple or a lazy excuse. Not saying that you're saying. I mean, I know you're asking the question. I'm not intimating that you believe that, but I think just to think that this one little hike, the market and the economy are so weak that one little hike broke everything. I don't believe that. I just think that last year, we started to see things weakening. I mean, economic data has been weakening, and to go back to what I just said, I mean, the Russell 2000, I mean, that already peaked. Global markets are really declining. So I think even if they didn't hike, I still think, we would have this crappy start to the year in the stock market. But yeah, I mean, as far as policy, it is an election year, so perhaps they won't do anything this year. I mean, that's also possible.
Yeah. I think for me, what was significant about the rate hike in December was I believe that it signaled the end of, at least for the time, the reversal of easy money and expansionary policies, even though they can always reverse on that. But they were at that point where it kind of signaled to the market that this is the end of that, and that now it's time to start raising interest rates again. And over the last few years, obviously the markets have been so dependent on all of these Fed policies, and so them continuing to do it, I just it's hard to know exactly what they're going to do going forward. But I really do appreciate your comments on that and your insight on the precious metals market. Jordan, is there anything else that you had in your mind that you wanted to share with our audience today? And please share some information about where our audience can learn more about what you do.
Oh, thank you so much. They can go to my website, thedailygold.com. I do some video updates there. I usually write one article per week, and I do some podcasts as well. I post interviews like this on there. And if they want to get my book for free, you can opt into my free email list. There's a big ad there on my homepage. And so I can send you my updated book or a copy of that. And my email list, I do an update every Saturday night or Sunday morning, and you'll get that every week, where I kind of talk about what I see happening and some of the things I was reading this week. And I usually post a chart or two for my premium update in there. So yeah, go to thedailygold.com and opt in for my free email list so you can get a copy of my book.
That's Jordan Roy-Byrne, everyone, of thedailygold.com. Jordan, thanks so much for taking the time to come on the show with me today.
Thanks for having me.